Hello, folks, and good Friday afternoon, and welcome to this week's weekly commentary. I know we're going to see a number of you later this evening at the Orioles Red Sox game in our double suite at Ed Smith Stadium. I think it's going to be a beautiful evening, should be a fun game and party. So we look forward to seeing those of you who will be there in a few hours. On another note, I know many of you were kind enough to offer us warm testimonials regarding your experiences over the years with Barcombe Asset Management. We are extremely grateful for those comments. Now, my wife Irina has come on board this year as our Director of Digital Presence, and she's doing a wonderful job on our website, our Facebook business page, our YouTube channel, etc. And it was she that encouraged me, should say insisted, that I start doing this commentary in digital form as I have over the past few weeks. She also today asked me during this commentary if I would request that for those of you who did provide testimonials and for those who would still like to, if you could kindly put them out on Google reviews. I don't mean to ask or impose too much, but she assures me that having those out there gives our firm greater presence on search engines. So we would appreciate it if you could take the time to do that. And if you do, I thank you very much ahead of time. All right, onto the commentary. As a reminder, you can watch and or listen to this commentary by clicking the photo above. So earlier this week, we saw the Producer Price Index spike in February. This before any potential inflation impact is felt from higher oil prices. Meanwhile, the most recent employment report showed greater weakness than economists had expected, giving rise to renewed fears of stagflation. While this development alarmed some, others were heartened by what perhaps could have been the greater likelihood of future lower interest rates as a result. And those cuts could have come sooner, as the Fed may have been in a position to do what they have done during past war-based oil price surges, and that is lower rates to blunt the hopefully short-term negative impact on inflation and GDP growth that past elevated oil prices have shown can potentially inflict. However, with higher than expected PPI numbers, which then typically spill into PCE, the Fed's preferred gauge for inflation in the coming months, the Fed's hands are tied and they can't justifiably lower interest rates at this time. Maybe if the president were to announce a 6-month moratorium on current tariff rates, it is possible to then see deeper and quicker rate cuts than we currently expect. Right now, however, the greatest threat to the economy and to the markets is the closing of the Strait of Hormuz and the escalation of attacks on oil-producing infrastructure in countries in the broader Middle East and the resulting impact that's had on oil prices. I don't mean to keep going back to tariffs and taking shots. I think you all know my frustration over this economic policy, but one more relevant shot, tariff policy, at least at the moment, seems to have also complicated alliance building for helping with the current effort to protect the Strait of Hormuz, to open it back up again, protect oil-producing infrastructure, and basically the overall war effort. I think we'll probably get that coalition put together soon, however. Iran, in the meantime, is hardly backing down, and in fact, their actions over the past few weeks seems to have increased the urgency and the necessity of taking out the existing regime once and for all. That, however, will prove to be challenging and, with current tactics, likely take more time than markets or the Western world will have patience for. While the United States has decimated Iran's military power and taken off the board one military leader after the other, leaving the regime currently in disarray, unfortunately it doesn't take much for Iran to continue terrorizing ships in the Strait, inflicting damage on their neighbors, and now threatening strikes around the globe as they have done this week, or at least threatened this week. It's been reported that over 90% of Iran's ballistic missiles and, importantly, launchers have been destroyed, and the regime has little ability to replace them, particularly those launchers. And even if we're unable to destroy what's left, they're going to run out of missiles sooner than later. That's the good news. The bad news is that Iran has what currently appears to be a near unlimited supply of drones. They're cheap, much harder to intercept in large numbers, and they're good at hitting infrastructure and soft targets. In other words, while these weapons alone offer virtually zero chance of winning the war outright, they are probably going to be effective enough to potentially win the war of attrition. Given what Iran has shown to be capable of doing these past few weeks when threatened, leaving the regime in place to rebuild their ballistic missile stockpile and resume efforts toward nuclear weapons, doesn't appear to be a good long-term option. As well, ending hostilities while the strait remains unopened likewise isn't a good option. And there doesn't appear to be any good options to effect a quick and lasting positive outcome. Now, options for effecting a positive inflation, GDP, interest rate, and market outcomes are easier, but still complicated. Time is urgent for this. The number one pressure point on all of these metrics is oil prices. Over the past 25 years, on an inflation-adjusted basis, Brent crude oil prices have averaged $75 to $80 per barrel. Today, Brent is priced at roughly $108 per barrel. That's considered stress mode or even crisis pricing. That is pricing in real supply risks, but not yet pricing in total disruptions. That would occur should prices spike to the $130 to $150 range, prices we haven't seen since the financial crisis. And recent direct strikes on Qatar LNG and Gulf infrastructure have only heightened concerns. Time doesn't appear to be on the side of the United States and the West, at least in terms of staving off a potential, even global recession. My suspicion is that behind the scenes there are efforts to end the hostilities sooner than later, reopen the Strait of Hormuz, while unfortunately leaving what is left of the regime in place with perhaps some level of assurance of no more recent or near-term future hostility. Now, at the same time, there may be plans in the works for a longer-term, less disruptive effort to finish the job of toppling the regime. This could be done through extreme economic sanctions, support for mass internal uprisings, including large-scale protests, strikes, civil disobedience, etc. That's actually how the Iranian Revolution happened. But at the same time, the RIG has proven to be ruthless in suppressing such efforts. So protecting protesters and strikers would require some kind of internal infiltration to disrupt those IRG efforts, whatever the longer-term strategy is. Iran's ability to disrupt oil flows even further than they have create, in my view, urgency to find a way past that. The next week should give us a lot more clarity on whatever the near-term strategy is and where this is going. And before it should become an actual energy long-term crisis. And while there are a number of positive events to write about offering encouragement for the economy, and market and economic growth, including what should have been stimulative banking deregulation and longer term likely will be, all other market influences are taking a back seat in the short term to the most urgent influence of energy costs. Meanwhile, markets continue to be resilient with no signs of panic among investors just yet. At the same time, even if investors' mood changes and panic does dominate, the resulting downfall would likely be short-lived, and it's foolish to try to time that kind of activity. As I wrote about last week, the two headwinds currently, tariffs and in particular oil prices, remain in the control of decision makers. This is not a spiraling, out-of-control series of events such as we experienced in late 2007 and throughout 2008 during the financial crisis, or even during COVID. Short-term, investors will be on edge as we work through this current crisis, and as always, I will be very closely monitoring these developments for any changes to this narrative that may require action on our part, and I will keep you up to date as often as I can. I thank you for watching/listening to this, and in the meantime, as I end, I want to wish you all a very wonderful, happy weekend.